Okay, so in today's video, we're going to be looking at chapter 18, looking at some cost behavior analysis information. So what we'll be trying to figure out in this chapter is how companies handle stuff like break-even point analysis and how we figure out exactly what needs to happen for us to earn a profit. There's a little bit more to it than that, as we'll see. We'll need to deal with some additional cost classification issues that we haven't really thought about in a while, and a little bit deeper level. We'll look at a couple of different methods, just scratching the surface on one or two of them and digging into a couple of the others. So we've got quite a bit of ground to cover, so we'll go ahead and get started here on the first question in chapter 18. So the very first thing that we're looking at here is cost behavior estimation using what is called the high-low method. Now, it's pretty straightforward. It's going to pick the highest point and the lowest point out of the data set that we've been provided. The only thing you have to remember is if we base that on the units produced or if we base that on the actual maintenance cost. As long as you understand which one determines the high and the low, then there's nothing you can really mess up here. So let's just look at this as if we had this on a graph. So if we had this on a graph and we were actually graphing June, July, August, etc., what we would probably set this up as the most reasonable format would be to have units on the x-axis and to have the cost or the dollar value on the y-axis. So what this relationship tells me is that the cost depends on the number of units, right? There's some type of relationship regarding the amount of money that we spend being related to the amount of units that we are actually producing. So what that means is that when we're using the high-low method, the high point and the low point are determined based on the activity level, not the cost, right? Not the cost. Do not make your determination by looking at this information, right? Sometimes it will be the same, right? Like in this case, we've got our low point as far as units appears to be December. So we'll be looking at something with December. Our high point appears to be November. I believe that actually does hold as far as the maintenance cost in this example. Like if you had accidentally based your determination on this column, you would have gotten the same answer. You still would have picked the right 2 months. But very frequently on the exam, I'll mix around that maintenance cost column a little bit. So I might mismatch the lowest maintenance cost and the lowest production level, for example. So I might put that 4,100 in June and that 5,850 in December and just see, do you really understand which one we're dealing with, right? So when we're making this initial determination, we do that based on the number of units produced or based on the activity level. That is the determining factor. Very good. So let's go ahead and wipe all that out and we'll go ahead and get started. So in this case, what we're going to see is we're starting out, and our basic formula here is going to be change in cost divided by change in volume. All right, so that's how we're going to handle this. So all we're going to do, this is essentially telling us the slope of a line. That's all this is doing. So if you remember back from Algebra 1, the way that we calculate the slope of a line is if we've got 2 points, we just take y2 minus y1 over x2 minus x1. And that's it. So what we're going to do is we're going to start with the high point. So let's do that. Start with the high point. And in this case, that high point is $10,400 minus my low point, $4,100. That gives me 4,300. That'll be my numerator. I'm sorry, that gives me 6,300. That'll be my numerator. And then we will divide that by my change in production. So my change in production is 240 units minus 60 units, and that is 180 units. Now, when we do the actual division, 6,300 divided by 180, we will come out to $35 per unit. Now, the question is, what does that 35 tell me? Well, that 35 is telling me that the only reason for the change in those two amounts, the only difference between the 4,100 and the 10,400 is because of the change in production level. So what that means is a cost that depends solely on level of production. Well, that's a variable cost. So that tells me that using this information, I'm projecting a variable cost per unit of $35 per unit. Now, at this point, we're able to simply come in and try to figure out, well, if that is the case, if this is my variable cost per unit, then can we figure out my fixed cost per unit? And I think we can, because hopefully we remember our overall cost equation that total cost is equal to two things: fixed cost plus variable cost. Or variable cost plus fixed cost, right? Doesn't make any difference, whichever order you want to put that in. So I'm just going to pull, let's say, December. So if we pull the information for December, our total cost in that case was $4,100. That is equal to my fixed cost plus some amount. I don't know how much variable cost is in total, but I do know that it's $35 per unit. And I also know that we produced 60 units during that month. So if I come down, the 4,100 simply comes straight down, no change there. So 4,100 equals fixed cost plus then 35 times 60. Well, 30 times 60 is 1,800 and 5 times 60 is 300. So that's 2,100. So now we have 4,100 equals fixed cost plus 2,100. Subtract the 2,100 from both sides, and you come down to $2,000 equals your fixed cost. So now what that means is that my fixed cost is $2,000 and my variable cost is $35 per unit. What that allows me to do is now I can estimate with any production level within the relevant range and say, look, this is what we would expect that to be. All right. So the $2,000 fixed, we expect to stay the same as long as we're in that correct range. The variable we expect to stay the same as long as we're in normal operations, right? We're not getting any massive bulk discounts. We're not getting anything like that. So this is our normal setup. So this is how we handle this. And you'll notice you could do this for the high point as well. I just did the low point, but you could certainly do the same analysis for the high point. If you did the high point, then you would simply put the 10,400 here, $35 plus, or $35 a unit times, in that case, it'd be 240. That would come out, I believe, to be, see, 8,400. And then whenever you subtract everything out, you'd come down to the $2,000 also. So it will work. And I do encourage you, if you're on the exam, right, take the extra minute or so, go ahead, do it both ways. That way you make sure you get the same answer. If you get the same answer, there's a very good chance you did it correctly. If you get a different answer, it's almost certain, or rather it is certain, that somewhere in your work you do have a mistake. So you want to go back and try to find that mistake. But that is our first question. Very good. Now, with that one done, we'll go ahead and we'll move on to number 2. So that is our high-low method. For next, we're looking at one of our other analysis techniques. We're looking at sales mix and break even. So they tell us here, US Mobile manufactures and sells 2 products. They sell both tablet computers and smartphones in the ratio of 4:2. Fixed costs are $115,700 and the contribution margin per composite unit is $130. What number of each type of product is sold at the break-even point? So the first thing that I've got to do is figure out break-even in units, but it's going to be a little bit different than what we might have seen in class, because this is not break-even in regular units. This is break-even in composite units. So what that's going to mean is that whenever I'm doing this, my initial number, I'm not going to be done. I'm going to have one extra step. So the way this is going to work, we're going to start off by taking my total fixed cost, which they gave us is $115,700 right here. We'll divide that by my contribution margin per composite unit, which is the 130. So we go ahead and do that. And when I do that, I find that I need 890 composite units. So now you say, well, that's great, but now what do I do? Well, now this is where the ratio is going to come in. We know that for each composite unit, there are a total of 6 products being sold. We've got tablet computers and we've got smartphones. And every time we sell a composite unit, we sell 4 tablet computers and we sell 2 smartphones. So that means a composite unit is actually 6 individual units. So using that ratio, we're going to be able to figure out exactly what that breakdown is. So now we're simply going to come in and take my 4 tablet computers times my 890 composite units. And that's going to give me 3,560 tablets that have to be sold, and then 2 smartphones per composite unit gives me 1780. Now I'll simply add those two numbers up. And when I do that, I'll come out to my total number of individual units that have to actually be sold. So when we first opened this question, we first looked at this question, it might have felt very confusing and very strange, but you can see how if you just take it one piece at a time, one step at a time, and dissect the information, you're going to be able to move through that question pretty effectively. So very good. Now, moving into our next question, we're going to be looking at number 3. So number 3, we're looking at this idea of operating leverage. You say, well, what the heck is operating leverage? How does it work? What do we do with it? Is it important? Is it not important? I mean, what is this thing? So the first thing that we've got to realize is what that formula for degree of operating leverage actually is. So the formula for degree of operating leverage is simply we take our contribution margin divided by our pre-tax income. And that will give me my degree of operating leverage. And you say, well, that's great. Let's see if we have the information that we need. Sting reports a contribution margin of 744, fixed costs of 496, compute the company's degree of operating leverage, and if sales increase by 20%, what amount of income will Sting company expect? So in this case, we look, we say, all right, do I have my pre-tax income number? I don't see it, but I do have contribution margin. I do have fixed costs. So can I calculate this number right here? And I think the answer is yes. So if you recall, whenever we're in this chapter, we're going to be using the contribution margin income statement with a significant amount of regularity. So whenever we come through, the way this works is we take our sales minus our variable costs, and that will give us contribution margin. We then back out our fixed costs. This gives us pre-tax income. We then back out our income taxes, and that will give us net income. All right. Now, this is, of course, a lot more abbreviated than the formal GAAP version of an income statement that we learned a lot about in 2301. We'll see it popping back up periodically throughout the course. But in 2302, this contribution margin income statement becomes very, very crucial. So make sure you understand this general format. So if we look at this, we say, well, all right, for this formula to work, I need contribution margin. And we look, and we do in fact have that. It's right here. That's my 744. But I need, for this to work, my pre-tax income. Well, right now, they gave me that I had contribution margin of 744. So what they've essentially told me here is that they've already taken care of this part, right? I don't know what the sales was. I don't even know what the variable costs were. But I know that when you just take the difference in those two, that difference is 744. And that's all I need, right? That's all the information that I actually need to make this work. The next thing that I've got to consider is my fixed costs. So now they told me, well, okay, we had fixed costs of $496,000. So now we'll simply back that out. 744 minus 496. And when we do that, that gives us $248,000. So this is my pre-tax income. So now whenever I actually want to calculate my degree of operating leverage, I have the information that I need. I now have my contribution margin of $744,000. And I have my pre-tax income of $248,000. And when I do that, that comes out to actually a nice clean 3.00, right? That's exactly 3. So you say, well, that's great. But what does that mean? All right, so what this is telling me is that the way my company is structured, for any percentage change in sales, that will be reflected threefold in income, right? That will be reflected threefold in that pre-tax income number. So what that means is that if there's a 20% increase in sales, that will lead me to a 60% increase in pre-tax income. This is incredibly powerful because what this means is that if I'm able to increase my operating leverage to a significantly large number, it doesn't take a very large change in the amount of sales in any period to dramatically improve the outlook of my company, right? If I had an operating leverage here of 10 and I had a 10% increase in sales, I would double my income. And you say, well, that sounds really nice. I say, yeah, it does. It does sound really, really nice. But is there an opposite side to that? And I think the answer is yes. Because the opposite side to that is, for example, in this case, we've got an operating leverage of 3. If we change that to a 20% decrease in sales, certainly a painful decrease, but nothing that we couldn't ordinarily overcome. But now that I've got this operating leverage of 3, now my income is going to be slashed not by 20%, but by 60%. So this operating leverage really does, it acts as a lever, right? If you're trying to lift something really, really heavy and you're right up against it and you try to lift, it's going to hurt, right? You're going to have some struggle there. It's going to be difficult. But if you get yourself a nice long lever and you're able to apply that pressure, it pops it right up and makes it much easier to move, right? It amplifies the force. Well, the same thing is true here. Whenever you have that higher degree of leverage, it's like making it easier and easier and easier to pick up the box. But it also means that if it goes the other way, that's going to come crashing down a lot faster, right? So it goes both ways. So that's why we've got to be kind of careful here. But the way this all works out is because that contribution margin is all dealing with that difference between your sales and variable cost. And then that pre-tax income is factoring in the fixed costs. So we're able to kind of encapsulate everything in this calculation. So very, very powerful technique here to see. Now, the question is not done though, right? The question did not ask me just for the percentage change in income. That was one part of the question, but it now asks me for the actual amount of income. So for the actual amount of income, in this case, what I'm going to do is I'm going to take the income that I'm starting at, 248,000, and I'm simply going to multiply that by 1 plus the increase, 0.60. And when I do that, I will come out to $396,800. So 248,000 times 1.60. And when you do that, that will give you the actual amount of income that we should be expecting. Very good. Very good. So this idea of leverage, very, very powerful stuff. Now, number 4. Number 4 is nice because here we're just looking at some graphical interpretations. So there's not a lot you have to really know on this one, right? It's not like a numeric question where you have to actually know the formula. This is just, do you understand the general behavior of the different types of costs that we're seeing in this chapter? So graph number 1, well, that is a strictly variable cost. And the reason that I know that is that whenever we have no volume, we incur no cost. And then as we ramp up the volume, our cost increases in direct proportion to the increase in volume. So for example, if I were to look at this triangle right here, right, this area, and then I looked at this triangle, and I looked at this area, those ratios would be the same. This triangle, of course, is bigger, but it's the same ratio of the side lengths because it's a directly proportional change. So this is obviously, because of those reasons, this is a variable cost. Now, number 2, we say, well, all right, when I have no volume, I don't have 0 cost. In that case, I actually still have a cost. I don't know how much, but I have a cost of some amount. And I look, as I ramp up production, that cost is not changing. So this cost is independent of changes in volume. Because of that, this is a fixed cost, right? A fixed cost. So it does not matter how much production we do, we incur the same cost. Think of something like rent. Whether I produce no basketballs in my factory, I pay the same amount of rent as if I produce 1,000 basketballs in my factory, right? It makes no difference. The company or the entity that I'm renting the building from, they don't care how much I use the building. Rent is rent. It is fixed. Now, number 3. Number 3 is, it's got some components of both a fixed cost and a variable cost. So we see that. Notice the fixed piece is that even when production volume is 0, there is still a cost. The variable piece, though, is as we ramp up production, the cost is increasing. So what we find is that this is what is called a mixed cost. So this is a mixed cost. This is something like your water bill or your electric bill, right? Even if you were to go out of town for a month, let's say you left on the 1st, you didn't come back to the 1st of the next month. You used exactly 0 electricity, you used exactly 0 water over that period of time. You had all of your appliances turned off, you had everything completely off, right? You used nothing. Well, you're still going to have a bill from those companies. Why? Because there's a fixed component to your bill. That's the portion that moves your y-intercept from 0 up, right? That's what's forcing this to go from right here to right there. It's that fixed component. But as we move down the line, that increase is occurring at a consistent rate, and that's because that is a variable cost. So if you think about electricity, this is per kilowatt hour, right? Each time you use a kilowatt hour, you're incurring some amount of cost. And here we're assuming it's the same amount the entire way. So that is a mixed cost. Now, number 4. You'll notice number 4 is interesting because, and I'm going to zoom in just a little bit if I can do it without messing up our, nope, can't do it without messing up our other graphs. But what I want to show you here is that this is a really interesting graph. I'm going to do my absolute best to make this consistent. But notice this distance that we just came over here and we went up. You notice how this is a fairly small gap here. I mean, is it an increase in cost? Yes. Is it a dramatic increase in cost? Not really. But now if we go about the same distance, right? So let's just say from right here to the end, right? Approximately the same distance. But notice the change in cost on this end. Notice how now we're moving from here all the way up. Do you see how this distance right there is significantly larger than that distance right there? That's because this is what is called a curvilinear cost. So I'm just going to put CV, right? It's curvilinear. What that means is that when you first start off increasing volume, you get pretty large gains, right? You're able to be very efficient with those early additions. But as you continue adding, the cost becomes prohibitive to adding more and more. And you'll notice this is actually starting to bend, right? So if this were to continue, what you would likely see is this graph starting to go asymptotic almost. At some point, the cost is just so extreme, it doesn't make sense to continue increasing production. The best example I can think of, and the example that I will always use most likely, is a call center. So if I operate a call center, right? So let's say I have decided that I want to open a call center. So I initially start out, I buy me 10 desks and I have 10 phones for 10 employees to call people. Well, initially I've got no employees. As soon as I hire one employee, I get a large boost in productivity. Then I hire a second employee. Because there's 10 phones, they just sit down at the next desk and they continue working. And this continues bringing me large increases in productivity all the way up until I hire that 10th person. But then once I hire that 10th person, when I hire the 11th person, I only have 10 phones. What are they going to do? Right? I mean, they might be able to get coffee for the other 10 people. We can rotate them through, right? So that they have more breaks and they're more efficient during their on time. They might start looking up numbers or compiling lists or doing something, right? And they may be providing some efficiency, but odds are they're not providing the same efficiency as the first 10. And now we hire a 12th person, a 13th person, a 15th person, a 38th person, a 200th person. You start to see how eventually we've got this office that was originally designed for 10 people, now fitting 400 people, right? Not only are we not being more efficient, we're actually doing nothing because now everyone's crammed together like this and no one can move, no one can get anything done because the costs become too prohibitive as you ramp up volume. So this is a curvilinear cost, right? Curvilinear costs just tell us that, hey, initially we get pretty large gains in productivity early on. But as that continues, as we continue increasing production, at some point we hit a wall and we just can't really get around it. All right, so curvilinear is what we're seeing here in graph 4. And graph 5 is interesting. It's what's called a step fixed cost or what I'm just going to abbreviate here is SW for stepwise. Imagine you've got a factory. Initially, you run 1 8-hour shift. So this is the cost for the supervisor who is over that first 8-hour shift. Whether you produce 1 item or 1,000 items, as long as that one shift can do it, this is the correct amount, right? It's a fixed cost within that relevant range. But as soon as you go one step above that, so let's say now our first shift can only produce 1,000 units. The second I want 1,001 units, I'm no longer at this level of cost. I now have to hire a new manager. So now we step up a layer. When we step up a layer, this is a second shift manager. So now my cost has bumped to this point, and this will be fine all the way up until 2,000 units. Then as soon as I want 2,001 units, well, we can't do it in 2 shifts. Now we've got to bump up 1 more layer. Now we have our third 8-hour shift, and that'll work from 2,001 units to 3,000 units, for example. So this is the idea of a stepwise cost. As long as you're within the range on any level, you don't need another level. So your cost can stay the same. Maybe this is you hiring a new supervisor, a new manager. Maybe this is you having to expand plant operations, right? Maybe Nike or Under Armour or some big company is looking at their operations and they say, look, right now we can only produce X amount of our material or X amount of our product. But if we had a new factory, then we could ramp up production even more. Well, that bump in that new factory, that's going to be another cost that they're going to have to consider. And they're only going to have to consider it in the event that they actually want that extra production. So this is a stepwise cost. Very good. So with that, we can go look at some actual examples and see what we're dealing with. So number 1, commissions to salespeople. That is, of course, a variable cost. That's graph number 1. Real estate taxes on the factory. Similar to rent on the factory, no one cares, right? Whether you're using the factory or not, if you own the factory, you pay the property taxes and they are the same. So number 2 is a fixed cost, and that is representative here in letter B. Letter C, electricity charge that includes a standard monthly charge plus a charge for each kilowatt hour. So exactly what we talked about earlier, that is a classic example of a mixed cost. You also see this with something like your water bill, not completely uncommon. And there are some other items just that the companies may run into that are structured as mixed costs also. I will mention mixed costs are the one that you've got to really watch out for if you're doing any kind of analysis using contribution margin, because you will have to divide that cost into its fixed and into its fixed and variable components so that you get an accurate allocation for things like contribution margin. Graph number 4 is representative of letter D. This is the cost of hourly paid workers that provide varying changes in efficiency as workers are added. That's pretty much going through the example that we talked through a minute ago about the call center, right? Whenever I only had a handful of people, large boosts in productivity. But as soon as I get beyond a certain point, those gains start to diminish. And then eventually it actually starts to come down, right? I mean, the cost will continue to increase, of course, but the actual productivity gains just fall off the cliff, right? And we actually start losing productivity because we just have too many people there, right? Just have too many people. The letter E, factory policy that requires 1 supervisor for every 30 factory workers. That's, of course, graph 5. So the way this one would work, if I have anywhere from 1 to 30 employees, I am operating at this level of fixed costs. But the second I hire that 31st employee, I now bump all the way until I hire 60. Once I hire 60, I'm still good. But as soon as I hire that 61st person, I have to bump because I now need a new supervisor. Very good. Okay, so those are our graphs. Very, very good question there. Next, we're just looking at some definitions. Number 1, this is the cost. This cost is a combined amount of all the other costs. Well, hopefully we all can kind of pick up on that being the total cost, right? Total cost is just all of the other costs combined. Now, this cost remains constant over a limited range, so up to here. Then when it reaches the end of that range, it changes by a lump sum and stays at that range until it needs to bump again. That's the exact definition of what we saw in that graph a second ago in graph 5. That's a stepwise cost. Very good. Number 3, This cost has a component that remains the same over all volume levels. So that's the fixed component, and another component that increases in direct proportion to increases in volume. That is the variable component. If it's got both fixed and variable, that is a mixed cost. Number 4, this cost increases as volume increases, but the increase is not constant, right? So whenever we looked at this curvilinear graph, what we saw was something like this, right? It was kind of wavy, but it certainly was not a line. If it was just a straight line, that's a variable cost. But that curvilinear graph that we looked at here, remember, it kind of bounced around, right? And that's because the change is not linear. So that's what we're seeing here. Number 5, this cost remains constant over all volume levels within the productive capacity for the planning period. A fixed cost does that. Doesn't matter. You produce 0 units, you produce 1 unit, you produce 10 million units. As long as it's within that productive capacity, it is not changing. Fixed cost. Number 6, this cost increases in direct proportion to increases in volume, and the amount is constant for each unit produced. That is, of course, a variable cost. Now we're going to get into some numbers. So number 6, a jeans maker is designing a new line of jeans called Slims. The jeans will sell for $320 per pair and cost $221 in variable costs. So these are very, very expensive jeans. So let's see how this works. In this case, the first thing I've got to do is calculate contribution margin. It's always pretty much a good idea if we're dealing with Chapter 18 information. Even if the question doesn't ask you for it, just calculate that contribution margin. It's a great habit to get into. It doesn't take you but 3 or 4 seconds, and you're probably going to need it somewhere in the question. So in this case, they actually do ask us for that. So we'll go ahead, pop that into our equation, plug and chug. Sales minus variable cost is contribution margin, 320 minus 220.80 is $99.20. Next, they've asked us to compute the contribution margin ratio. So for the contribution margin ratio, this is contribution margin per unit divided by selling price per unit. So contribution margin per unit, we calculated right here. So we're simply going to pull that $99.20 down into this calculation. We'll now divide that by my sales price per unit of $320. So $99.20 over $320, and that is a 31% contribution margin ratio. So for every dollar in sales, we get about 31 cents to help cover fixed costs. And then once fixed costs are completely covered, that 31 cents will become income. Number 7, Blanchard Company manufactures a single product that sells for $140 per unit and whose total variable costs are $105 per unit. The company's annual fixed costs are $563,500. So right away, just because we're in the good habit of doing so, we calculate contribution margin. 140 minus 105, we see that's $35, and we've now got it to work with. Next, they want a contribution margin ratio. For that, we just take contribution margin per unit divided by sales price per unit. 35 over 140 is 25%. Next, they've asked us for break even in units. These are 2 incredibly important formulas you must know for the exam. You must know these 2 formulas for the exam. You must know these 2 formulas for the exam, right? I hope I've been clear, as well as anything related to contribution margin, right? Contribution margin ratio, you're going to have to know. Contribution margin, you're going to have to know. It's a lot of formulas in this chapter, but 2 of the most important ones are these break even formulas. But you'll notice that within those are those contribution margin formulas. That's why I say you have to know all 4. If you do not know all 4 of these, you cannot do the questions in Chapter 18 on the exam. You can't. You will not be able to work out the math. So here we go. In this case, if we want break even in units, what we do, we take our fixed costs in dollars. We divide by contribution margin per unit. And when I do that, what I find is that I end up with 16,100 units. So that tells me how many units I need to sell to break even. At this point, you've got 2 options on how to proceed. If you want, after you have break even in units, if you want break even in dollars, one way is to take your units that you just got, 16,100 units, times your sales price per unit. And when you do that, you will get $2,254,000. The alternative way is how the book is doing it here. You do need to know both ways, because if I give you a question, I may not give you the information to do either one. You may have to know, based on the information I've got, here's the formula that I need. So the other way is to take simply fixed costs divided by our contribution margin ratio. In this case, our fixed cost, $563,500 divided by our contribution margin ratio of 25%. Comes out $2,254,000. Now, in this case, where did that 25% come from? Well, we saw it earlier, right? That was what this calculation was. And this is in fact why they asked you for this, not because you really needed it here, but because you were going to need it here. All right, so that's why the question included that. Very good. Okay. Now we'll go ahead, move on to number 8. Here in number 8, we're looking at income reporting, and this one you've got to be a little bit careful with, and just to make sure that you understand how it's set up. So what I'm going to do, I'm just going to mock out what they've got. So sales minus variable costs, that gives us contribution margin minus our fixed costs, and that will give us, in this case, they're calling this net income. Now notice earlier we would have called this pre-tax income. Right? So why are they getting away with calling it net income? Well, what they've asked me for is what's called a contribution margin income statement, a break-even income statement, which means we're doing this where net income is 0. And if net income is 0, then pre-tax income was 0. So then I can say that pre-tax income equals net income, and I can get away with putting either title here. Now in this case, we're going to select net income for that bottom number. So at this point, we're going to have to work backwards a little bit to figure out how this one gets solved. So what do we know net income has to be equal to if we're doing a break-even income statement? Well, net income has to be 0. So let's start there. Let's start at the bottom and work up. Now, they told us our fixed costs were equal to $596,000. So we can drop that in right there. And for my contribution margin minus my fixed costs to equal 0, that must mean that my contribution margin is equal to my fixed costs. So that means that contribution margin must also be $596,000. So now we're moving up. We're making some pretty good progress. This is the point where most students will get stuck. If you're going to get stuck, this is where most of the time it happens is, okay, we've got this, but how do we get these two numbers, right? I understand that in a break-even income statement, net income is 0. That makes sense. It's break even. We earn nothing, right? Net income is 0. That I got it. I also understand that for that to be true, contribution margin and fixed costs have to equal. But how do I go backwards? So this is where we've got to lean on some algebra. So the first thing that I'm going to tell you to do is go ahead and just calculate that contribution margin in dollars. And if you do that, you'll get 160 minus 120, and that's $40. Now that you've got that, you can take that $40, divide it by the 160, and that'll give you 25%, and this is your contribution margin ratio. That 25% can then be plugged in right here. Right there. So now what we know is that 25% of something, so 0.25x equals $596,000. So how do I solve for x, in this case, total sales? Well, I'll say that x equals 596,000 divided by 0.25. So I'll divide that 0.25 on both sides. When I divide on the left, it'll cancel out and just leave me with x, or just leave me with sales. And then I'll do the division on the right, and that'll allow me to see that x, in this case, is equal to $2,384,000. So now this $2,384,000 simply flips around and plugs in up top. And of course, sales is 100% of sales, so that becomes there. Now, there's two ways to get this last number at this point. One way is to simply take the 2,384,000 times the 75%. So if you do that, 2,384,000 times 0.75, you will in fact come out to 1,788,000. So that's one option that you have. So one option is to say, well, if I've got 100% of sales, and after I back out variable costs, I'm left to 25% of that, that's contribution margin. And that must mean that sales times 75% equals variable cost. So I'll simply do that. 2,384,000 times 0.75, and that is 1,788,000. That's one option that you have. Certainly nothing wrong with that option. It's a good option. The other option is to treat this as just a basic plug and chug. 2,384,000 minus, and then just subtract out your contribution margin, 596,000. And when you do that, you will also come out to 1,788,000. So however you want to go about it is perfectly fine. I don't care that you know both methods necessarily, but do be able to do one of them, right? Do be able to do one of them, and do certainly be able to work from the bottom up as we just did. All right, it's very intuitive for us to take a formula like this and just plug in top down, but that's not always the way you're going to be tested. It's pretty frequent for me to decide, hey, let's see if we really know how this works, and let's start at the bottom and work up with a break-even income statement. So that's the way that would work. Very good. Now, number two, assume the company's fixed costs increased by 134. What amount of sales in dollars is needed for break-even? Well, in that case, total fixed cost goes from 596 to 730. Contribution margin ratio, you'll notice, doesn't change because that's a change in fixed cost. So contribution margin ratio is unaffected, because contribution margin ratio is sales minus a variable cost over sales. The fixed cost is changing. That's nowhere in the formula for contribution margin ratio. So we simply take the 730 over the 25, and that's 2,920,000. Now, a very common type of problem for me to give you is to say, all right, our fixed costs increased, but they increased because we automated. And because of this automation, we now are able to reduce our variable costs from, say, $120 down to $100 per unit. And if that happens, then your contribution margin ratio does change. And now you've got to change on both sides. Now you've got to figure out, well, what is actually going to happen to break even point in dollars? Is it going up? Is it going down? What do we see? Right? What do we see? Very good. Number 9. So this one's very similar to the last one. We're just making one small change. Now we don't want break even. Now we want income, right? Have you ever heard anyone say, hey, I'm going to start a company because I really just want to make nothing, right? I want no profit ever, right? That's what I want. I don't want to ever have a single dollar in profit. Is that why people go into business? Is that why companies start up? I don't think so, right? I think companies start up because someone has a really good idea and they say, hey, I think I can help out other people with this, but I think I can also help myself out and be pretty profitable with this. So what we're going to do is actually determine a target amount of income and see, well, to hit that amount, how much do I have to actually generate in sales? So Blanchard Company manufactures a single product, sells for $104, and whose variable costs are $78. Company's annual fixed costs are $369.2, and management targets an annual pre-tax income of $650. Assume fixed costs remain at $369,200. So in this case, we'll take our fixed costs plus our pre-tax income. So in this case, that's the annual fixed cost of $369,200 plus the $650. When you do that, that's $1,019,200. Divide that by my contribution margin per unit. Remember, contribution margin per unit is sales minus variable costs. That's contribution margin per unit. Well, we'll just call that contribution margin. As long as all these are in per unit, then of course that is still true. But this also works in total. That's why I went back on it. Because if you had total sales minus total variable cost, you end up with total contribution margin. So there we go. So in this case, there's our contribution margin of 26. And that's what we see. So we'll simply take the amount that we've got to cover, divide it by $26, and that gives me my number of units, 39,200. Now, to compute the dollar sales, I'll simply take my 1,019,200 divided by 25%. That 25% is, of course, my 104 minus my 78. Or if you want, you could just use that 26 that we already calculated divided by 104. That is, in fact, 25%. And so now you'll simply take your fixed costs plus your pre-tax income divided by the 25%, and here's your 4,076,800. Now, of course, you could check that number by taking your 39,200 times $104. So 39,200 units times $104 per unit, and that will be 4,076,800, because that will work also. So do be aware that that is, of course, a fine option. In the multiple choice, that is perfectly fine with me if you decide to just go that route. On the worked out problems, if Connect forces you into this formula issue, then this isn't an option to get points. It's certainly an option if you can't figure out, hey, what is the actual formula? I don't remember, I'm struggling on the test. Go ahead, figure out what the number is, and you can play with the math a little bit and figure out, well, what formula would make me come out to that? And they'll give you a pretty good shot at actually getting the points on the exam. So do be aware of that. Now, moving on to number 10, we're predicting sales and variable costs or contribution margin once again. So Bloom Company Management predicts it will incur fixed costs of $266, earning pre-tax income of this amount. Expected contribution margin ratio is 54%. They want total dollar sales. Hopefully we're pretty familiar with this by now. Fixed costs plus pre-tax income divided by contribution margin ratio. There's our total dollar sales. Then we simply come in. In this case, they did give me the information a slightly different way, but if we remember our normal formula, sales minus variable costs equals contribution margin minus fixed costs equals income. Then whenever I come in this case and I'm looking for variable costs, all I'm doing is rearranging this a little bit. So if I just rearrange this sum, right, I would be moving that income to the other side. So truthfully, let's just get rid of this. All right, we don't need the contribution margin. It'll be a little bit more clear without it. So I've got sales minus variable costs minus fixed costs equals income. Well, if I subtract income to this side, and then I add variable costs to this side, what that becomes is sales minus fixed costs minus income equals variable costs. And that's exactly what we see here. Sales minus fixed costs minus pre-tax income is variable costs. And so it does in fact work. That's the point, right? That's why this formula is what it is in this case. Now it's just a matter of pulling in the numbers that they asked for. So we figured out on the first part, our total dollar sales. That's what we did here, 1,160,000. Now that we've got that, we're simply going to pull in the fixed costs and the pre-tax income that they gave us, and that'll tell us what the variable cost number must be. And with that, we have finished number 10. Now we're moving into the last set of questions using this company named Hudson Company. And so we've got 3 questions using the same set of information, and we'll make some changes to it as we go. But this is the general setup that we'll be using. So in number 11, they just say, hey, compute break-even point in units and compute break-even point in sales dollars. So the first thing that we've got to remember is that break-even point in units is simply calculated as fixed costs divided by contribution margin per unit. So fixed cost divided by contribution margin per unit. This equals break-even in units. And then for break-even in dollars, we can take our break-even units times our sales price. And that will be the easiest way to do it, right? That's how I recommend you do it in this, because it doesn't ask you for the formula, right? We don't have to do the fixed cost divided by the contribution margin ratio. You certainly can. But in my opinion, if once we've calculated break-even in units, just use that information to get the next piece. So let's see how this works. In this case, well, we've got our fixed costs, so $504,000, and we have our contribution margin per unit. But the question is, how do I get that number? So I see the 504, but I don't see where they've actually told me what the contribution margin per unit is. So I think I'm going to have to figure it out. And the way that I can figure it out is by just looking in those parentheses for each one of these lines. So I can see that each unit sells at a price of $300. So 300 minus 240. Yeah. So 300 minus 240. And when I do that, I'll come out to 8,400 units. 8,400 units. So there we have it. So there's my break even in units. Now my recommendation is just take that 8,400 units times $300 per unit, and that will give you $2,520,000. And that's your break even point in dollars. So this is break even in dollars, whereas this right here, this is break even in units. So break even in units, okay? So that's how this works, right? And so that's all we're going to be doing as we just kind of work through this, is just looking at different facts for this company, but mostly just moving that around a little bit. Now, number 12, assume Hudson Company has a target pre-tax income of 161. Nothing else changes here. Well, if that's true, then all we're doing is we're taking that same formula that we used a second ago, the 504,000 divided by our, well, all right. In this case, it might be helpful if we went ahead and had that contribution margin ratio, just so we don't have to do the extra step here. So I'll go ahead and show that calculation. So in this case, the first thing is I'm going to go ahead and get the contribution margin ratio. So contribution margin ratio, if we scroll back up, we find that our sales price was 300, our variable cost was 240. So contribution margin ratio will be, in this case, 300 minus 240 divided by the 300. Oops. And that is 20%. So this is 60 over 300, that's 20%. I'm now able to figure out my target sales by taking my 504,000 plus my 161, and then dividing that by 20%. When you do that, this should come out to 3,325,000, and that is the total amount of dollar sales that are actually needed in this case to achieve that target profit. But the next thing they ask is, well, what's margin of safety? And this is something we haven't talked about in this video yet. We should have talked about it in class though, or you should have read about it in the book if you're an online student. But in this case, what we find is that margin of safety is pretty much exactly what you would think it is. So what I'm going to do is I'm just going to take that 3,325,000. I'm going to subtract my break-even number that we got earlier, 2,520,000. So 2,520,000. And then I'm going to divide all of that by my actual expected sales of 3,325,000. And when I do that, I should come out to 24.20%. And that is what we find here. So there you have it. So that is all it is, right? How much could my sales decline before I'm no longer making a profit, right? And so in this case, if we hit this amount of sales, they could dip by 24% before we start making, or before we stop making a profit. All right, so very, very good. So 3,325,000 minus the 2,520,000 over the 3,325,000, and that comes out to about 24.2%. Very good. So with that, we'll go ahead, clear all that. And now we're just going to play a little bit more make-believe, and they say, well, what if these following things happen? What if the company raises its selling price to $320 per unit? Then what happens to contribution margin? Well, we remember sales minus variable costs equals contribution margin. Before sales were 300, and now it's 320. They didn't tell me variable cost changed, so that's still 240, which tells me then that contribution margin bumps to 80. Well, now contribution margin ratio will equal that $80 divided by the new sales price of $320, which is 25%. So 80 over 320 is the 25%. Next, we just need our break-even point, and that break-even point will be our total fixed cost. I didn't say anything about that changing. Divided by 25%, our new contribution margin ratio, and that's $2,016,000. And finally, the very last thing, whoops. I skipped a step. I went straight to this. But for a break-even point in units, which was what I was supposed to do there, I'm sorry, you take $504,000 divided by our $80 contribution margin per unit, and that is, of course, the 6,300 units. So these two are flipped in order. Because of the annotation on here, I don't know how to move text boxes around. But the information is correct, right? This 2,016,000, this is our break even in dollars. So break even in dollars here. And this is our break even in units here. Okay. Now, a couple of things I want to point out before we wrap up here. Notice where we started. Where we started, we had a break even point of 8,400 and a break even point of 2,520,000, right? That was when I had a $60 contribution margin because my sales price was 300, my variable cost was 240. But now that my sales price has increased, nothing else changed. Notice what happened. My break even point became much earlier. And in sales dollars, I now need $500,000 less in sales to break even. And this is a much better situation if I can get away with it, right? If my product will actually continue selling at this rate of 320, this is a much better outlook for my company. Now, compare here the 3,325,000 to the 2,520,000. Does it make sense that we are requiring more sales? I think it does, because here we're not trying to break even. Here, we're trying to achieve a profit of $161,000. So of course I'm going to need to sell more than if I just wanted a profit of nothing. So it does make sense that my amount of sales required in number 12 is greater than the amount in number 11, but that my amount of sales required in 13 is less than the amount of sales required in both 11 and 12. So if you kind of rationalize what you're doing and say, hey, does that make sense given what's actually happening? Then I think it'll help keep you straight as you work through these questions. But as always, if you have any questions at all, if you're at all confused on anything, feel free, swing by my office, send me an email. I'm always happy to chat, and I would love to meet with you on this information. So y'all have a good one. We'll pick up back in chapter 19. Thank you very much.